In 1990, Australia was falling apart. Interest rates were sitting at 17%. Unemployment was climbing past 10. Businesses were closing. Houses in Sydney that would one day sell for $2 million were worth less than $150,000. And even at that price, people couldn't afford them because the repayments would eat you alive. Picture Josh. He's 25, a tradie in Western Sydney. Work's dried up. He's doing 3 days a week if he's lucky. His brother-in-law, always the one with ideas, tells him over a beer to put $1,000 into the share market. Josh nearly chokes. "Mate, the country's going down the toilet and you want me to throw $1,000 into stocks?" He doesn't do it. He puts the money in a term deposit instead, earns his 8% interest, and feels smart about it. Here's the thing. If Josh had ignored every instinct telling him to stay safe and put that $1,000 into the Australian share market in 1990 and then never touched it, never panicked, never pulled it out during any of the 6 major crashes between then and now, that $1,000 would be worth somewhere north of $40,000 today. And that's just the price going up. With dividends reinvested, we're talking about a figure that makes your term deposit look like loose change behind the couch. That's not a hypothetical designed to make you feel bad. It's the actual maths of how the Australian market has behaved over 36 years. And the uncomfortable truth is that Josh's instincts, wait until things are safe, wait until you understand more, wait until you have more money, are the exact same instincts that keep most Australians from ever building real wealth. Not because they're stupid, because nobody ever explained how this actually works. That's what this video does. In the next 25 minutes, you're going to understand how money grows when you leave it alone. Why superannuation is the most powerful financial tool most Australians never think about. What the share market actually is and isn't. Why every crash in history has been temporary. How the most boring investment strategy on earth keeps beating the experts. And why Australia has a hidden advantage that most countries don't. You don't need a finance degree. You don't need to pick stocks. You just need to understand about 6 things, and then the whole picture clicks. Let's start with the most counterintuitive one. You've probably heard the term compound growth, maybe in school, maybe in a YouTube ad, maybe from your parents if they were the type to talk about money, which most Australian parents aren't. And if you're like most people, you heard it, nodded, and immediately forgot it, because it sounds like something you'd learn in year 10 maths and never use. Here's why that's a mistake that costs people hundreds of thousands of dollars. Compound growth means your money earns returns, and then those returns earn returns, and then those returns on returns earn their own returns. That sounds simple. It is simple. But the way it plays out over time is genuinely wild, and I had to draw it out on paper 3 times before it made sense to me. Imagine you invest $10,000 and it grows at 8% a year. After year 1, you've got $10,800. Not exciting. After 5 years, you've got about $14,700. Fine. After 10 years, about $21,600. You're thinking, okay, it doubled in 10 years, that's nice. But then, something happens. Between year 20 and year 30, the growth isn't just continuing, it's accelerating. By year 20, you've got about 46,000. By year 30, you're past 100,000. The same 10 grand. No extra contributions, just time. That's the hockey stick. For the first 10 or 15 years, compound growth feels like nothing is happening. You'd look at your balance and think, why am I bothering? Then somewhere around year 15 or 20, the curve bends upwards so sharply that the last 10 years of growth do more work than the first 20 combined. Compound growth works like a snowball rolling downhill. For the first 100 meters, nothing happens. You'd think it's broken. Then somewhere around meter 200, it gets heavy enough that it picks up speed on its own. The last 50 meters do more than the first 200 combined. That's the whole point. And that's why the 1990 investor is a millionaire. Not because they were clever, not because they picked the right stocks, Because they started, and then they didn't stop. The market went up, it crashed, it went sideways, it crashed again, it recovered, it boomed, it crashed a third time, and through all of that, compound growth kept doing its thing. The only people who missed out were the ones who pulled their money out during the scary parts. Quick pause. Let that sink in before we move on. Because everything else in this video, super, shares, ETFs, all of it, is just a different way of putting that snowball at the top of the hill. The vehicle changes. The principle doesn't. Now let's talk about the single biggest investment most Australians have, and the one they think about the least. Superannuation. Super. The thing on your payslip that you know exists but have never really looked at. If you're working full-time in Australia right now, your employer is putting 12% of your salary into a super fund every pay cycle. That's not optional. That's the law. And as of July 26, with the new payday super rules, that money arrives with every single pay run, not quarterly like before. But here's where it gets interesting. Picture Priya. She's 24, working her first full-time gig as a grad in a corporate office in Melbourne. HR hands her a form on day one. One question says, nominate your super fund. She's never heard of any of them. She doesn't know what Host Plus is. She doesn't know what Australian Super is. She picks the default, whatever that means, and doesn't think about it again. 5 years later, she changes jobs. Nobody tells her she now has 2 super accounts, each charging fees on money she forgot existed. She changes jobs again, 3 accounts, then 4. By the time she's 30, she's paying 4 sets of admin fees, 4 sets of insurance premiums, and the total is quietly eating thousands of dollars out of her retirement without making a sound. That's like paying 4 separate rents to store the same furniture in 4 different warehouses that you never visit. I'm going to be honest. The first time I saw what super fees can do over a lifetime, I didn't believe the numbers. The average Australian will pay more in super fees over their working life than they'll spend on their car. Not a luxury car, any car. And the difference between a high-fee fund and a low-fee fund, compounded over 40 years, can be the difference between retiring with $400,000 and retiring with over $1 million. Same contributions, same market. Just fees. Now rewind to 1992. That's when the government made super compulsory. Before that, super was a perk. If you worked for a big company or the government, you might get it. Everyone else got nothing. In '92, Paul Keating's government said every employer has to pay super, starting at 3%. It went up gradually, 4, 5, 6, 7, 8, 9, 9.5. It sat at 9.5 for years. Then it started climbing again, 11, 11.5, and now 12%. The final legislated increase. Compulsory super is honestly one of the smartest things any government has ever built, and one of the worst explained. The entire idea is that if you force people to save a little bit with every paycheck, compound growth does the rest over 40 years. It's designed to work without you understanding it. And for most people, it does work. But the gap between it working okay and it working brilliantly comes down to 2 things. Where your money is invested inside the fund, and how much you're paying in fees. Most Australians never check either one. Your super fund takes your money and invests it. That's what it does. It buys shares, bonds, property, infrastructure. Your balance goes up and down with the market. If you're 25 and your super is sitting in a conservative option, heavy on cash and bonds, you're essentially asking your snowball to roll across a flat car park for 30 years before it finally reaches a hill. If you're in a growth option, mostly shares, you'll feel more bumps along the way, but the snowball hits the steep part of the hill much earlier. There's a whole rabbit hole about self-managed super funds, contribution splitting, and transition to retirement strategies that I'm not dragging you into today. This video is about the engine, not every bolt. But the thing you can do in 5 minutes that might be worth more than anything else in this video is log into MyGov, check how many super accounts you have, consolidate them, and look at what you're paying in fees. 5 minutes, potentially tens of thousands of dollars over your lifetime. Now, the share market. The thing that scares most people away from investing, mostly because of how it looks on TV. When you hear the share market or the ASX, your brain probably conjures images of people in suits yelling numbers on a trading floor, red and green arrows flashing on screens, and the vague sense that someone somewhere is making a fortune while you're missing out. That's not what the share market is. The share market is a place where you buy tiny pieces of real businesses. That's it. When you buy a share in BHP, you own a sliver of a mining company. When you buy a share in Commonwealth Bank, you own a sliver of a bank. When you buy a share in CSL, you own a sliver of a biotech company. Those companies make money. They sell iron ore. They charge interest on loans. They develop vaccines. And when they make money, some of that money flows back to you as a shareholder, either through the share price going up or through dividends, actual cash payments sent to your account. The ASX, the Australian Securities Exchange, lists about 2,000 companies. The ASX 200 is the 200 biggest. Together, those 200 companies make up about 77% of the entire Australian share market's value. When people say, the market went up today, they usually mean the ASX 200 went up. And here's the thing that still blows my mind. Since the ASX 200 was created, it's returned about 8% a year on average, including dividends. Not every year. Some years it's up 20, some years it's down 40. But on average, over the long run, about 8%. That doesn't sound exciting until you remember the snowball. 8% compounded over 30 years turns $10,000 into over $100,000. Over 40 years, over $200,000. And that's without adding a single extra dollar. But wait, if the market averages 8%, why isn't everyone rich? Because of what happens in the scary years. Picture Liam. He's 32, a FIFO worker in the Pilbara. He's been putting money into his super for 10 years without thinking about it. Then the GFC hits. 2008. The ASX drops 43% in a single year. Liam logs into his super and watches his balance shrink. Every day, it's less. He calls his fund in a panic and switches everything to cash. At least it can't go down anymore, he tells himself. The market bottoms out in March 2009. Then it recovers. By 2013, it's back to where it was before the crash. By 2019, it's higher than it's ever been. But Liam missed the recovery. He sat in cash for 6 years, too scared to switch back, watching the market climb from the sidelines. That's the cost of panic, not the crash itself. The crash is temporary. Every single crash in Australian market history has been temporary. Everyone. The 1987 crash, the dot-com bust, the GFC, the COVID crash in 2020. The market fell 30% in 5 weeks and recovered within 18 months. Even the correction in March 2026, when the ASX dropped 8% in a few weeks because of oil price shocks from the Middle East conflict. By April, it was climbing again. I know. I had the same reaction. How can every crash be temporary? Because the companies inside the market keep making money. They keep selling products. They keep hiring people. They keep innovating. A crash is the market panicking about the future. A recovery is the market realizing the future still showed up. And the future has shown up every single time. Here's the mini revelation that changes how you think about this. The question isn't, what if the market crashes after I invest? The question is, what if I don't invest and the market keeps going up for the next 30 years, like it has for the last 120? The risk isn't volatility. The risk is absence. Stay with me. The next part is where it actually clicks. So if shares are how wealth grows, and super is the vehicle the government built to get you there, the question becomes, What's the smartest way to actually own shares? Do you pick them yourself? Do you hire someone to pick them for you? Do you just hope your super fund is doing a good job? The answer, for most people, turns out to be the most boring option imaginable. ETFs. Exchange-traded funds. Picture May. She's 27, a barista in Brisbane, saving for a house deposit. A friend shows her a TikTok about investing. She's skeptical. Isn't that for rich people? But she opens an account on one of the Australian investing platforms anyway. She starts putting $200 a month into something called VAS. VAS is an ETF. It stands for Vanguard Australian Shares Index ETF. And what it does is simple. It buys a tiny piece of every major company on the ASX. All 300 of them. When you buy 1 unit of VAS, you're buying a slice of CBA, BHP, CSL, Woolworths, Telstra, and about 295 others. You don't have to pick which companies will do well. You own all of them. If you want to own companies outside Australia, which, given that Australia is about 2% of the global share market, you probably should. There's VGS. Vanguard's International Shares ETF. It buys companies across 23 developed countries. Apple, Microsoft, Toyota, Nestlé, Samsung, you name it. And if you want both Australian and international in one fund and never think about it again, there are all-in-one options like VDHG or DHHF that mix Australian shares, international shares, and a small allocation to bonds into a single product. One purchase. Done. The fund rebalances itself. I'm not going to pretend this clicked for me the first time. It didn't. The idea that the most effective investment strategy is basically buy everything and do nothing sounds too simple. It sounds like a trick. But the evidence is overwhelming. Study after study shows that low-cost index funds, which is what these ETFs are, beat the majority of professionally managed funds over any 10-year period. Not because index funds are magical, because the fees on managed funds eat into returns, and the stock pickers, on average, can't consistently beat the market they're trying to outsmart. Owning one stock is like putting your entire house on one number at a roulette table. An index fund is like owning the table. You don't need any number to win. You just need people to keep playing. And the cost? VAS charges about 0.07% per year. That's $7 for every 10,000 invested. Some managed funds charge over 1%, $100 for the same 10,000. Over 30 years, that difference compounds into tens of thousands of dollars. Fees don't sleep. Now let's talk about something genuinely unique to Australia. Something that most Australians have heard of, but almost nobody actually understands. Franking credits. If you own Australian shares, directly or through an ETF, and those companies pay dividends, you'll run into franking credits. And the first time you see them on your tax return, you'll stare at the screen the way May did. Confused, then amazed, then slightly annoyed that nobody mentioned this earlier. Here's how it works. In most countries, company profits get taxed twice. Once when the company earns the money, corporate tax. And again, when the company pays a dividend to the shareholder, income tax. Australia said, "That's not fair." And in 1987, the government introduced dividend imputation, also called the franking credit system. Under this system, when a company like Commonwealth Bank pays 30% corporate tax on its profits and then pays you a dividend from those profits, you get a credit for the tax the company already paid. So if you're on a 30% marginal tax rate and the company already paid 30%, your additional tax on that dividend is zero. If you're on a lower tax rate, say 16%, you actually get money back. The ATO sends you a refund for the difference. That's wild when you think about it. The Australian tax system essentially gives shareholders a refund for taxes a company already paid. It's one of the most investor-friendly structures in the world, and most Australians who own shares, including through their super, benefit from it without even knowing. The moment when you see how franking credits work is one of the most satisfying things about learning Australian finance. It's the system doing exactly what it was designed to do and doing it quietly. Now, there's a question that comes up constantly, and it's one of the hardest ones in Australian personal finance. It's the one Tom and Sarah are arguing about in their kitchen in Adelaide. Tom's a teacher. Sarah's a nurse. They bought a unit 3 years ago with a variable rate mortgage. Rates have gone up 3 times this year alone. The RBA cash rate is sitting at 4.35%, which means their home loan rate is somewhere around 6.5%. Tom wants to throw every spare dollar at the mortgage. "I want that thing gone," he says. Sarah looks at the numbers and says, "But if the market returns 8% on average and our mortgage costs 6.5%, aren't we better off investing?" They're both right and they're both wrong. Paying down your mortgage faster is a guaranteed return. If your rate is 6.5%, every extra dollar you put in saves you 6.5% in interest, tax-free. That's a guaranteed, risk-free return. You cannot lose. Investing in the share market historically returns about 8%. But it's not guaranteed. Some years it's -20. You have to stomach the volatility. And the returns are taxable, though franking credits help. The answer isn't one or the other. It's understanding what you're actually comparing. Paying off your mortgage is buying certainty. Investing is buying probability. Most Australians do best with a bit of both. Smash the mortgage enough to feel secure, invest enough to build wealth outside the house, and make sure your super isn't sitting in cash doing nothing. Every situation is different. What you've just learned is the framework, not the answer, for your specific circumstances. Now let's zoom out, because here's where everything connects. In 1990, the Australian share market was at 1,280 points. Today, it's at 8,700. That's just price. With dividends, the total return is dramatically higher. In 1992, compulsory super began at 3%. Now it's 12%. The first ETF listed on the ASX in 2001. Now there are hundreds, managing over $200 billion collectively. Investing platforms that used to charge $50 per trade now charge 5 or 0. The infrastructure that exists today for the average Australian to build wealth is unrecognizable compared to 1990. You can open an investing account in 10 minutes. You can buy a slice of every major company in the world for the price of a pair of sneakers. You can consolidate your super on your phone while you're eating lunch. You can set up automatic contributions that buy shares for you every month without you thinking about it. The tools are better, cheaper, and more accessible than at any point in history. The only thing that hasn't changed is the behavior. People still wait. People still think they need more money to start. People still panic when the market drops. People still assume investing is for other people. The 1990 investor who put $1,000 in and never touched it didn't have better tools. They had worse tools. Higher fees, less information, no internet, no ETFs, no apps. They just started and they didn't stop. That's it. Let's talk about the mistakes that keep people from doing the same thing. The first one is waiting. I'll invest when I have more money. The problem is that compound growth rewards time more than amount. Starting with $50 a month at 25 will almost certainly beat starting with $500 a month at 45. The snowball needs distance, not size. The second is ignoring super. Your super balance isn't just a number on MyGov. It's your largest investment. If it's in a high-fee fund with a conservative allocation and you're 30 years from retirement, you're bleeding money every day without feeling it. Paying high super fees is like having a slow leak in your tire. You don't notice it on any given day, but over 30 years, you've been driving on a flat and wondering why the ride was rough. The third is panicking during crashes. The March 2026 correction scared a lot of people. The GFC scared even more. But every person who sold during a crash and didn't buy back in is the person who turned a temporary setback into a permanent loss. The market recovers. It always has. The only question is whether you're in it when it does. The fourth is assuming property is always safer than shares. It might feel safer because you can see a house and you can't see a share. But property comes with stamp duty, council rates, maintenance, insurance, LMI if your deposit's under 20%, and the reality that a single property in one suburb is the opposite of diversification. Property can be a great investment, but it's not inherently safer. It's just more familiar. The fifth is thinking you need to pick individual stocks. You don't. The evidence is clear. An index fund that costs almost nothing outperforms most expensive, professionally managed funds over the long term. You don't need to be clever. You need to be consistent. Here's what you've actually learned in the last 25 minutes. 1. Time in the market beats timing the market. The 1990 investor wasn't brave or smart. They just didn't quit. And compound growth did the rest. Slowly at first, then all at once. 2. Super is the most powerful investment most Australians have, and the most neglected. Consolidating your accounts, checking your fees, and making sure your money is invested for growth, not sitting in cash, might be worth more than any other financial decision you make this year. 3. The most boring investment strategy on earth: buy a low-cost index fund, contribute consistently, and don't touch it for decades. Isn't sexy. It's not exciting. It won't make you feel like a genius at dinner parties. But it's the one that actually works. And it works because it takes your emotions out of the equation and lets the maths do what the maths has always done. If you want to go deeper, the Barefoot Investor is a solid Australian-specific starting point. The Vanguard Index Chart, a free poster you can find online, shows every major asset class in Australia going back 30 years. And if you do nothing else after this video, log into MyGov and look at your super. Just look. Know the number. Know the fund. Know the fees. Here's the thing that keeps me making these videos. Most Australians will work for 40 years and retire without ever understanding where their money was or what it was doing. They'll pay hundreds of thousands in fees they never saw. They'll miss decades of growth because nobody told them to start early. They'll sit out every crash and miss every recovery. And it won't be because they're irresponsible. It'll be because the system that's supposed to help them never bothered to explain itself. If this video means one person opens MyGov tonight, checks their super, and starts asking the right questions, that's the whole point. Remember Josh? The tradie in 1990 who didn't invest that $1,000? His brother-in-law did. They're both retired now. The difference between them isn't talent, or luck, or income. It's one decision, made 36 years ago, and then the discipline to not undo it. The best time to start investing was 1990. The second best time is today. This is general education, not personal financial advice. If you need advice tailored to your situation, speak to a licensed financial advisor.